Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, China's factory activity in May shrank for the first time in 8 months. And that's according to a private sector survey that was showed on Tuesday. That's indicating U.S. tariffs are now starting to directly hurt the manufacturing superpower. And while the China and U.S. did agree to significantly lower their respective trade tariffs in May, U.S. tariffs against China still remained at historically high levels. In fact, according to U.S. Treasury Secretary Scott Bessent, he said that talks are still a little bit stalled. So with the possibility of trade tensions reinvigorating to unprecedented levels, what does this suggest about the prospects of China's economic outlook? Also, amid news of a significant number of investors looking to diversify portfolios internationally, away from the U.S., that is, where can we find opportunities? Let's find out with Thomas Taw, the head of APAC Investment Strategy at BlackRock. Good morning, Thomas. How are you doing today?
Morning, Dan. How are you?
I'm good myself. Thanks for joining us so early in the morning. Now, let's first turn our attention over to China, where we've got their manufacturing sector reporting its worst slump since September of 2022. That's as higher tariffs took a toll on smaller exporters despite a truce in a trade war with the U.S. And interestingly, that's far weaker than the official PMI reading released on Saturday, which showed manufacturing contracted less thanks to the reprieve on tariffs. Give us your take on the release of China's PMI data, and what does this suggest about the impact of tariffs so far?
Yeah, great question. So, I would say obviously the manufacturing data is important. China is a very big exporter, but what I would say in terms of trying to figure out what the impact is from tariffs, it's very difficult because, we're seeing front loading and pausing, and then we're seeing back and forth.
Yeah.
I think, what's actually more important for Chinese equities is what's going on onshore in terms of the overall consumer sentiment. So yes, the preliminary manufacturing data was slightly worse than expected, but what we've seen is actually domestic investors buying significant amounts of Hong Kong listed stocks. The number is somewhere around 8 billion so far this year. So it's actually more about consumer sentiment and about consumption in China, because that's something we haven't really seen much since COVID. And we're seeing quite strong earnings revisions to the upside for Chinese corporations. So I would say those things are actually more important than what the export numbers and the manufacturing numbers are.
Right. Does this then suggest that, optimism is returning in terms of consumer sentiment? It's returning back into Chinese stocks?
I wouldn't say it's super optimistic, but given how low the base level was, not just in terms of valuations and earnings, but also in terms of consumption. And then when you add that into the huge amounts of cash that are sitting in Chinese households at the moment, I saw some estimates saying somewhere around 20 trillion US dollars in bank deposits. And they haven't really been investing over the last 4 or 5 years post-COVID. So there is a lot of money on the sidelines, and that appears to be going into the Hong Kong-listed Chinese companies at the moment.
Right. That's a fair point. Thanks a lot for that, Thomas. Now, on the back of China's contracting PMI, one other reason why Chinese stocks are rising after the weak data on Tuesday was because of the fact that there were hopes of more stimulus, because just recently Chinese President Xi Jinping reaffirmed his plans for manufacturing-led growth during a visit to the northern province of Henan, pressing ahead with a strategy that was long criticized by the U.S. and major trade partners for deepening global trade imbalances. So he did say that, they will be advancing manufacturing, and it is the right path for China and the backbone of its economy. So talk to us about the possible impact of Xi Jinping's reaffirmation of plans for a manufacturing-led growth model, and where do you see opportunities for growth?
Well, I think it's been pretty clear over the last few years that they are trying to move to a more self-contained, self-sufficient type of economy. And that's not just China, that's kind of everywhere. So in terms of the policy implications from that, the foreign investors have been quite disappointed over the last 4 or 5 years around lack of policy implementation. And then, obviously last September we had a big shift. And I think it's important because when you look at the foreign holdings of Chinese equities, they're very, very low, somewhere around 1% of global AUM. That's nearly 3 times smaller than the holdings of just one company, which is Apple. So I think foreign holdings being very small, having to catch up on that with policy implementation plus the onshore money in bank accounts that's moving into Hong Kong listed Chinese companies. I think there is still some room to the upside here for Chinese equities. But then I think the question becomes, do you buy the onshore names or the offshore names? Because they are moving quite differently at the moment.
Right. Thanks for that, Thomas. Now then, many analysts have also noted that stimulus alone isn't a silver bullet and that deeper structural challenges like youth unemployment, real estate sector instability, weak global demand as well remains unresolved. So what then should investors be monitoring, and how should we be thinking of diversifying in, let's say, either the offshore or the onshore?
Yes, I mean, I always say this is, for me at the moment, this is more of a tactical trade than a longer-term structural trade. So the areas you pointed out there are still relevant, right? Debt, deflation, and the demographic situation are long, ongoing issues there. But given where valuations are, the holdings from foreign investors, and then the money that's available to invest into offshore, those things create quite a nice tactical trade. The question of how long it will last is always a very difficult one to answer. But I think for me at the moment, the trade is still the offshore names, because those are kind of the consumption-driven names. But as you start to see more policy implementation, that will drive more of the domestic type of names, because they are much more sensitive to liquidity provisions onshore. So I think that rotation trade will start to happen in the second half of the year.
Fantastic. All right, thank you so much for that, Thomas. Now let's shift gears over to the U.S. Treasuries, because just recently, BlackRock revealed that it is doubling down on its underweight stance on long-term U.S. government bonds, and it's echoing across markets, with many slamming the Trump administration's fiscal package, calling the so-called Big Beautiful Bill a big ugly bomb that is likely to blow the future deficits wide open. So it begs the question, are we expecting a bond market crash?
That's a big question for so early in the morning, but I think certainly it looks like with the fiscal situation there and the tax bill and some of the ongoing geopolitical issues, plus tax cuts as well coming later in the year on the personal and corporate level. These things are all inflationary, right? So we expect bond yields to continue to rise on the long end. They have been very volatile, as you pointed out. We're seeing a little bit of a pullback in volatility, but certainly, for us, it's still about sticking to the shorter end of the duration curve. That seems to make a lot more sense at the moment. So everyone is looking at the bond market and the U.S. dollar depreciation, and equity markets seem to be kind of ignoring what's going on there, maybe because the corporate strength in U.S. companies has been so strong. Yeah, certainly a hard road for investors to make sense of what's going on, but we'll wait and see how things develop over time, and if the market or economic data provide more signs on where the market is headed. Now, amid the global market uncertainty that we're in today, BlackRock has also identified 5 key mega forces that are poised to create big shifts in profitability across economy and sectors, while highlighting major opportunities and risks for investors. Can you expand a little bit more on the 5 mega forces that's shaping the investment landscape today? Well, I think the main one at the moment is really just on the sustainability, obviously one, the transition to green type of investments. But I think that the one that's in everyone's mind at the moment is kind of the AI trade, where the profitability will come through, what the capital expenditure for these Mag 7 companies is going to be moving forward. It seems like it's going to move lower. So I think in the shorter term, you're going to see a little bit more volatility in those names, but I think the trend is clear that this is a real thing, and it's going to impact how investors are looking at asset allocation. And what we're starting to see now is the first leg of this trade was really just semiconductors, right? So we need chips to power everything, and now we're starting to see it move into the software, the data storage. Infrastructure, I think, is going to be a big one moving forward. But these are kind of what I would caveat is these are all the very long-term trades, but at the moment investors are very, very concerned about the short term in terms of geopolitics, tacticals, fiscal situation, etc.
That's for sure. All right, thanks a lot for that, Thomas. Now, before we let you go, we got to talk about, where we can see opportunities for diversification, because apparently there are some people just diversifying their portfolios internationally away from the US. And some of these places they've noted include the APAC. So where are you seeing, increasing opportunities for growth in APAC? And could you be specific with sectors as well?
Sure. It does seem that in APAC, the inflation versus growth mix is slightly better than in the U.S. at the moment, in which you have central banks that have more ability to cut interest rates. Because when you look at the swaps curve for interest rates in the U.S., the projections of cuts is going down and down and down because of inflation. In Asia, for us, it's really about three different trades. I think we've kind of covered China already as the tactical shorter-term trade. I think Japan is still the more medium-term trade. Wage growth is doing well there. We're seeing good earnings growth. Inflation is coming back, and then you have India, right? So I think in that spectrum, India is much more the longer-term structural growth trade. But there have been concerns about valuations, retail participation, et cetera. So I think when you look across that spectrum, India is the one that investors still want to buy over the long term. So we continue to see keep buying there. So that's kind of equities, and then we broadly like Asia credit as well. Not so much Asia high yield at the moment, but certainly Asia credit looks quite interesting because of that inflation growth dynamic that we're seeing across the spectrum. But when we look at equities, it's really about China, Japan, and India in kind of chronological order.
Right. Fantastic. That was a very, very comprehensive breakdown of where we should be looking at here in APAC. Thank you so much for breaking all down for us this morning, Thomas.
My pleasure. Thanks for having me, and see you again soon, hopefully.
Yes, likewise, Thomas. We've been speaking to Thomas Taw, the head of APAC Investment Strategy at BlackRock, talking all about China's economic outlook as well as the opportunities that he sees in APAC region. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.